Hello to all, and thank you for joining us from all over the globe today. I am Anis Ali. I look after NRI products with ICICI Bank, and we are delighted to welcome you all to our yet another insightful webinar. Today, our endeavor is to simplify the recent union budget and its effects from a taxation perspective. But before I invite our guest speakers to share their thoughts and insights on this complex subject, let me quickly reiterate that sending money to India is now more convenient and seamless with our M2I and SmartWire platforms. Also, making payments in India can now be done using UPI through international mobile numbers too, subject to conditions, of course. To know more, you can visit our website and navigate to NRI Edge for detailed information. So with this, I now invite Mr. Pramod Achyutan and Ms. Meera Iyer from EY to join us today. Pramod is a partner at EY in the Tax and Regulatory Services practice and is based out of the Pune office in India. He is a meritorious chartered accountant, passed company secretary exams, and holds a bachelor's degree in commerce and has 24 plus years of experience in individual tax, corporate tax, and international tax matters relating to MNCs and Indian companies across a wide range of industries. A quick introduction about Meera. Meera is a director in the People Advisory Services practice and is also based out of the Pune office in India. She too is a chartered accountant with over 12 years of experience in tax and regulatory services covering Indian income tax, labor laws, social security regulations, FEMA regulations, and payroll structuring. So with this brief introduction, I will now request Pramod and Meera to take over. Over to you.
Yeah, thanks. Thanks, Anis Ali. Thank you for this opportunity. And yeah, good morning, good afternoon, good evening to everybody on the call. It's our privilege to be presenting this to you. The finance minister presented her 8th budget, and this happened last Saturday, and it was quite interesting. What I normally do is I look at newspaper headlines, the day after to see, what is the message that's coming out. And the Economic Times had a heading, "Common Man on the Moon." That was the heading. And Mint had a heading to say, "Spend India, Spend." So basically, this budget, the theme that is coming out is, there's a lot of good things that the FM has done, insofar as individuals are concerned. And there's a lot of reduction in taxes that she has done for individuals. And the hope is that individuals will go and spend this money, invest this money, and thereby boost the economy. That's the brief background. I'll now jump into my slides. And what I'll do is before I get into tax specific changes, I just wanted to, the way we are going to do today's schedule is, we will first talk of the budget. I'll touch upon some of the key takeaways from the budget. Then my colleague Meera, I'll hand it over to her at that time, and she'll take us through some of the basics around tax residency insofar as NRIs are concerned, taxation, heads of income, tax rates, and some of the typical issues that we've seen coming up for NRIs. And towards the end, we've kept 15 minutes for Q&A. That's the construct that we are going to be following, starting with the budget takeaways. This what you can see on the left hand side in the graph, you can see the trend of the real and nominal GDP growth for India over the last 7 years. And the FY21 number where you see a big dip, that was due to COVID. And after that you had a big hike, that was, you can say, base correction that happened in FY22. Now for the last year, this current year, ongoing year, FY25, we are finally going to end the year with about 9.7% of nominal GDP growth and real GDP growth of about 6.4%. And for the next year, what is projected is, the FMS projected a nominal GDP growth of 10.1%. So, those are the GDP numbers which are there. On the bottom table, from IMF projections, we've tabled, how, different countries around the world are growing. If you look at the world in general, it's about 3.3% GDP growth, that is being seen on an average, both FY25 and, for the next year as well. That's the budgeted growth that is there. And India at 6.4, real GDP growth, is doing phenomenally well. And amongst, it's the fastest growing economy amongst the large economies in the world. And you can see the Europe area is at 1% going to 1.4%. China from 4.6 to 4.5%. So these are some of the key numbers. US is from 2.7, it's going down to 2.1. And there's a lot of changes happening in US, with a lot of new announcements coming through, a lot of tax changes likely. So we'll see what happens to these growth numbers. But India is really a shining star. That's one takeaway. Coming to the right side of the graph, the fiscal deficit, that's the other big message from the budget. The FM mentioned that for FY25, she's managed to restrict the fiscal deficit to 4.8% of GDP. This was anticipated at 4.9 at the start of the year, so there's an improvement there. And for the next year, again, the FM said 4.4% is where we will end up with. That's what we are budgeting as at the start of the year, which again shows that fiscal discipline has been maintained, which is good from a sovereign rating perspective, and good investors look at it very positively. So we believe that that's a very good sign. And the FM also mentioned that instead of focusing on fiscal deficit, we are going to more focus on what is the GDP, debt to GDP ratio. We want to bring down debt, and we want to focus on bringing down debt over a period of time. And if you look at the center's debt, the middle column, the center's debt, for the next year is, it's expected to be 55.1% of GDP. So that's the total debt for center. And then when you combine the total debt taken by the states, the combined debt comes to about 82.6%, which is a large number. But, there is a downward trend there that you see, which is positive. And, the goal is to get to a debt to GDP ratio about 50%, by 2030. So, which is again a positive. So, with that, I'll now jump into some of the key tax changes, and one of the tax changes is a change which is not yet there. The FM mentioned that, she's going to table a new income tax bill. This is likely to be tabled next week. And this bill is, she said that the idea is that, we want to simplify the tax law. Today's Income Tax Act, which was, which is there from 1961, that has about 6 lakhs words. The idea is to come up with an act which will have only 3 lakh words, so make it half in size, make it simple to understand, try and reduce litigation. Those are the objectives. We need to wait and watch. This bill is not yet out in public domain. It's likely to be tabled in the coming week in Parliament. So that's one big change which will come up, but it did get announced by the FM, when she made a speech on Saturday. The next big change, and this was again a mega change, like I mentioned at the start, which is a significant change in the slab rates. And there's a new slab rate which has been introduced, and my colleague Meera will take you through later on, on what these specific changes are. But the big takeaway is that up to 12 lakhs of income, you resident individuals, don't have to pay tax anymore. So that's one, big bonanza that she is given. And somewhere the FM mentioned that, these income tax changes, especially on the individual tax front, they are going to result in a loss of about 1 lakh crore for the government for 1 year. So that's a big number that she is giving in, and the idea is that this amount of extra money that she is putting into the pockets of all people, they will use it to boost consumption, and we'll need to wait and watch how that pans out. But a big positive change insofar as individual taxation is concerned. In the next one, and Meera will take us through more details on this, and you can ask questions also as we go along. The next one is on TDS and TCS provisions. So a lot of tax deduction at source, thresholds have been amended, and I think one big one there is on rent. If you have a property on rent, if the value is in excess of, there is a TDS to be done by the person taking property on rent if the rent exceeds annually 2,40,000. Now the number has been changed to 50,000 per month, or part of the month, from next year onwards. For non-residents, these thresholds may not really apply, and in all cases, TDS may need to be done, but this is a change that has come in. I think for TCS, tax collection at source, which happens especially when LRS is done from India. If there are foreign remittances to an overseas bank account, then there is a TCS that happens. On amounts in excess of 7 lakhs, there was a TCS happening at about 20%. 7 lakhs threshold has now gone up to 10 lakhs, so which is a positive change. And similarly, there's a 0.5% TCS which was applicable insofar as remittances for educational purposes were concerned. Now again, that TCS has been completely removed if it is for remittance from a loan obtained from some specified financial institution. So again, educational related remittances, there's a positive change. The next change is a change pertaining to filing an updated return. So today, you file a return, typically if the year ends on 31st of March, by 31st of July, you need to file the return. And you can file a belated return by 31st of December. That's the normal time limits. And then there's a 2-year limit given for filing an updated return, where in addition to the tax, you need to pay certain additional penal amounts, but you can still file a updated return within a 2-year period. The 2-year period for an updated return has now been changed to 4 years, so it is giving much more time. And what we have seen is, the way this is intended is that, if something has been erroneously skipped out in your earlier returns, then, you can use this opportunity to voluntarily go and pay the tax and the additional penal amount. And what that will ensure is that you will not get a penalty later on. So, that it is a way to avoid penalties. The government is saying that it has got a lot of data, it has collected a lot of data. It has, in fact, immediately after this change was announced, we heard a lot of clients got SMSs, from the income tax department saying that if you need to file an updated return, please proceed to do that. So that's a new change which has come in. I think on the insurance policy, couple of changes. ULIPs, which today there is a specified procedure for taxation of certain types of ULIPs. So if the total premium paid in a year is in excess of 2.5 lakhs, then those ULIPs end up getting taxed, and they are taxed as capital gains. But some of the older ULIPs and some of the ULIPs where the premiums paid were below 2.5 lakhs, if they end up, getting redeemed, how should they be taxed? There was some debate and controversy on that. It was getting taxed as income from other sources. It has now been clarified going forward that this will be taxed as capital gains. So that's one clarification that has come in. And another welcome clarification is any non-residents availing life insurance from a IFSC insurance unit or office, that sum, will not be taxable going forward. So, it's a positive change. Today, there are a lot of conditions, for getting an exempt life insurance payout. Those conditions, in terms of 10 times of premium, for ULIPs, there's a 2.5 lakh threshold. For other policies, some cases there's a 5 lakh threshold. So all of those, this is now saying that, if you have a life insurance policy, a lot of those conditions, will go away if it is taken from an IFSC unit. And I think the last one is around self-occupied properties. Today the law says that, you can treat 2 houses as self-occupied with a nil value. And one of the houses, there were some conditions attached to get a nil value, that you were not able to occupy the second house on account of your employment in another place. Now they have said without any conditions, we will make both these houses, 2 houses, we will treat it as self-occupied. Of course, any of these houses should not be given out on rent. They should be lying vacant. So that, that's the way you can get this nil value. So these were some of the key changes from a personal tax perspective. And, if you have specific questions, you can put them in the chat box. I'll now hand it over to my colleague, Meera. She will take us through some more of the finer nuances around residency, tax rates, and, some typical issues applicable to NRIs. Over to you, Meera.
Thank you, Pramod, for those detailed insights on the budget-related changes. And going to some of the typical aspects that globally mobile individuals have to counter when it comes to dealing with tax in India. The first one is residency. So whenever determining taxability of income in India, or what needs to be offered to tax in India, the first step there is determining an individual's residency. And the second is where the income is earned and actually received. So in the first step, now there are these detailed conditions that you can see on the screen, and these conditions we would say have been pretty static for quite some time, but still the complexity is such that for each individual case based on the day-stay pattern of every year, they need detailed evaluation. So the first condition is wherein an individual needs to be classified into a resident versus a non-resident. So in case if someone has stayed in India for more than 182 days in a specific tax year or financial year, beginning from 1st April to 31st March, that individual would be a resident. Or if he has stayed in India for more than 60 days in that specific tax year and more than 365 days in the previous 4 years, then also he would be a resident. So meeting either of these conditions would make you a resident in India, and not meeting either of them would make you a non-resident. Then once you are a resident, and there are some more sub conditions which I'll talk about, but once you are a resident, in order to classify you into a not ordinary resident or an ordinary resident, that is RNOR versus ROR, there are some additional conditions that have been prescribed, where in case if an individual has been a resident in 2 out of 10 previous years and has lived in India for more than 730 days in the previous 7 years, then that individual would be a resident and ordinary resident. If either of these conditions are not met, so in case if someone has been a resident in only 1 year out of the previous 10 years, or if someone has lived in India for less than 730 days in the previous 7 years, then such individual would be a not ordinary resident. And we'll talk about why is this important. But there are some substitutions when it comes to certain categories of individuals. So when we spoke about the first condition, wherein an individual who stayed in India for more than 60 days in the present year and 365 in the 4 years, this 60-day threshold gets substituted when an individual, an Indian citizen, leaves India in a financial year for the purpose of employment. The 60-day gets replaced by 182 days. Then, in case of an Indian citizen or a person of Indian origin who is typically based out of India and comes to India on a visit in a financial year, if such an individual has income from Indian sources, or the way the law reads, income other than from foreign sources, and if such income is less than 15 lakhs, then 60 days again gets substituted by 182 days. However, if the Indian income is more than 15 lakhs, then the 60-day gets substituted by 120 days. Now, these changes are not from this budget. They were brought in 2 years ago. And the reason the government had introduced this was to bring high net worth individuals who are managing their residency in a manner in which they are covered in low tax jurisdictions or no tax jurisdictions into India by tightening these visit related days. Also, there was one more concept that was introduced, which is of deemed residency. Now, who is a deemed resident? An Indian citizen whose total income other than from foreign sources. So India sourced income exceeding 15 lakhs, and who is not liable to tax in any other country by reason of domicile residence or any other similar nature. That person would be a deemed resident of India, and such individual would be treated as a resident but not ordinary resident, RNOR. Now, deemed residency, as soon as the provision was announced, there was a lot of discussion on what happens to people based out of the Middle East, working, employed in the Middle East. How does this get treated? So there were some clarifications that came out that what is important to find out is not liable to tax in that jurisdiction because of residence and all, which might be met for people in the Middle East. But what will be taxed in India is only the India sourced income. So it is not, there was a misconception that it is the global income that will get taxed in India. That's not the case. We are referring to the Indian income only that would be taxable, and which, I mean, there's not much of a difference when it comes to a non-resident also. And maybe we'll just go on to the next slide and we'll talk about this. So when we talk about the scope of taxation for different residential statuses, so for an ROR, ordinary resident, the individual is taxable in India on the worldwide income, needs reporting of global assets in India, and you can draw various benefits under the double taxation avoidance agreement, and we'll talk about all of these concepts as we go along. As for a non-resident, that such kind of an individual is taxable in India only on income that is received in India for the first time, or income that such individual earns in India or accrues in India. And not ordinary resident is an individual where the tax treatment is pretty similar to a non-resident, but what gets added is income from a business controlled in or a profession that is set up in India. So very important to determine the residential status. How is this residential status to be determined? Strictly basis the passport stamps. What is important is that the day when you enter India and the day when you exit India also gets added while determining how many days you've lived in India. And we have seen in the tax return, you need to disclose your residential status. So we've seen that depending on information exchanges that keep happening between different countries, if the authorities believe that there were some foreign assets, foreign income that need disclosure, but there is a specific residential status that you have mentioned or disclosed in your tax return, then there are summons, there are notices that the authorities issue wherein they ask you to substantiate your residential status based on the passport stamps. So very important to one, preserve your passports, to keep actively track of what is the number of days stay that you've lived in a specific year in India. Another important point, there are some European countries and all where residential status is seen based on the purpose for which you are in that country. There might be some exceptions in case if you are on a holiday or something, or days where you are actually carrying out employment is what gets considered. But in India, no such bifurcation. It is the physical stay in India for whatever purpose that gets considered. These are different heads that you see on the screen, basis which income gets classified in India for the purpose of taxation. And for each of these heads, there are different tax rules that are applicable. There are many rates that are specified. Also, the double taxation avoidance agreement that we've been referring to, there we can see such kind of bifurcation. So very important for you all to be mindful that these are different heads under which income is taxable in India. Going on to the tax rates, and Pramod touched upon this as the most important budget related amendment, we would agree, because if you see right now in the country, there are two types of tax regimes that are available, which is the old tax regime and the new tax regime. The new tax regime was introduced in the year 2020. When the regime was newly announced, there were hardly some takers for that. With each budget after that, the finance minister has added more and more benefits there, changed the slabs, and keeps on giving more impetus to this regime, because now the government's intention is to make the new tax regime as the default regime. And a move in the similar direction has been this year as well, where you can see on the rightmost side where the proposed new tax regime related heads have been indicated. So the slabs have been enhanced, wherein up to 4 lakhs there will not be any income tax, 4 to 8 lakhs 5%, 8 to 12 lakhs 10%, 12 to 16 15%, and so on. So with this, we can see that there is one more slab of 20 to 24 lakhs, wherein 25% of tax rate has been introduced. And above 24 lakhs, there is a 30% tax, as against if you see the old tax regime, wherein above 10 lakhs itself, there's the 30% tax rate that kicks in. So yes, at the outset, the proposed tax regime is more beneficial. Now, at a very basic level, I'm sure all of you all are aware, but under the concessional tax regime, the tax rates are lower, there are more number of slabs, but you need to forego various kinds of exemptions and deductions. Hardly a couple of them are available under the new tax regime. Vis-a-vis under the old tax regime, you get HRA, LTA, Chapter 6A, 80C, Mediclaim, various deductions and exemptions that are permissible. So that's the basic point of differentiation. Now, looking at these slabs and the headlines in various newspapers, which says that up to 12 lakhs of income is tax-free. So where does this 12 lakh rupee number come in? So there is also, in addition to the enhancement of these slabs, there is something called as a rebate, which is available only to resident individuals, so not available to non-residents. That rebate has also been enhanced from 25,000 to 60,000 under the new tax regime, and it is 12,500 rupees under the old tax regime. So as a result of which, 12.75 lakhs is the number that we are referring to, wherein 75,000 is the standard deduction that is available under the new tax regime, which then reduces the income to 12 lakhs. And if you calculate the increasing taxes at up to an income of 12 lakh rupees, that comes up to 60,000, which is the value of rebate that the government has granted. So as a result of which 12.75 lakhs for a resident individual would be completely tax free. Whenever we are discussing these regimes, the question that we get most frequently asked is what is that magic number basis which we decide to switch to the new tax regime or continue in the old tax regime. So now with the present proposals that we are discussing, that number has been heightened by the government. So up to exemptions and deductions up to 8 lakh rupees. So if you have something in excess of 8 lakh rupees, then for an individual with income above 24 lakhs, the old tax regime would be beneficial. Otherwise, it's the new tax regime itself. And I mean, if you ask us, 8 lakhs is a pretty high number for anyone to meet, even if we consider the classic HRA, LTA, then housing loan, PF, and such kind of deductions that are permissible, still reaching that 8 lakh rupee number becomes challenging. As a result of which, we can see that increasingly more number of people would now be in the new tax regime. And yes, like Pramod pointed out, the government's intent for doing this was ensuring that the disposable income in the hands of the individuals goes up, and which can then boost spending in the economy. And I think this move has been the most well received. So everyone, all the common man is all happy with the budget this time with this kind of a change that has been brought in. Now, on the income tax that is applicable, there is also surcharge that kicks in. So this has been constant. There's no change after this budget. But one point of differentiation is that under the old tax regime, if someone has income above 5 crores, the surcharge is at 37%. Whereas under the new tax regime, above 2 crores, the surcharge gets restricted at 25%. So that also is one more reason why the new tax regime becomes more attractive. So a couple of pointers here are that new tax regime is the default tax regime. For people without business income, you can switch between the regimes on a year-on-year basis. The final selection needs to be made at the time when you file your tax return for the year. There are calculators available on the income tax portal wherein you can key in details of your income, identify which is the regime that is more beneficial for you. Also, in case if you want to opt for the old tax regime, which is not the default regime, then you should ensure that your tax return gets filed before 31st July. The normal due date of 31st July, you ensure that your tax return with the old tax regime being chosen gets filed before this date. So with this, now we spoke about the various heads of income that are available. And what we've done here is that we've just broken those heads of income and put in some common tax rates that are available for them. So yes, of course, there are going to be a lot of factual aspects that need consideration whenever we talk about tax treatment of any source of income, what tax rate would be applicable and all. But before we touch upon the tax rates, maybe a couple of minutes on the tax treaties or the double taxation avoidance agreement. I'm sure you all are familiar with this term, must have used it time and again. But for people who maybe need some more insight on this. So double taxation avoidance agreement is an agreement that various governments have signed up with various countries. So India has signed this agreement up with almost 90 countries, wherein the reason that this agreement is put in place is to ensure that there is no double taxation of any income. And the ways in which this double taxation gets eliminated is there are a couple of ways in which it is done. So the first one is an exemption method. That is, the income would be taxed in only one of the countries. The other one is availing foreign tax credit. That is, if the income is taxable in two countries, then the country of which the individual is a resident can pull in credit in respect of the taxes paid in the other country. Or then for various heads of income, there are beneficial tax rates that have been prescribed in the tax treaties. So very important whenever you have a multi-country income or multi-country role that you evaluate, one, the residency in your in India and the country in which you are based. Identify the residency under the double taxation avoidance agreement. Depending on the source of income, there is a detailed study carried out of what would be the tax rate that would be applicable and which tax treatment would be more beneficial, whether under the Indian income tax law or whether under the double taxation avoidance agreement, because there is an option available to choose either of them that is more beneficial to you. In case if there is any relief that you will be availing under the under the DTA, then it is suggested that a tax residency certificate is obtained from the jurisdiction of which you qualify as a resident. In case if there is any foreign tax credit that is to be availed in India, then there is an additional filing, Form 67 filing that kicks in. So that also you need to be cognizant of. So all in all, very important to take a detailed opinion or maybe understand in detail, study these various aspects before you determine and report in your tax return the correct tax treatment, the correct tax rate, because we are seeing that the income tax department is increasingly using technology in terms of information exchange with various countries and for analysis of the tax returns, as a result of which for any incorrect disclosure, the level of scrutiny that the authorities are carrying out is very stringent. So extremely important for you to be mindful of these aspects. So with that, the first head of income that we'll be speaking about is salary. Now, salary, typically globally mobile employees with payroll in one country, working in the other country, or family being in one country and working in the other country, there are a lot of complications that kick in. Just to keep it simple, under the Indian Income Tax Act, salary is taxable at the regular tax rates that are applicable, the normal slab rates depending on the regime chosen. And under the DTA, while there may not be a beneficial tax rate, there is something called as a dependent personal services clause that is available, where you can exempt based on the work days where you have actually carried out this employment. You can figure out in which jurisdiction this income would be taxable, and if not, there is always an option of availing foreign tax credit. Salary income also incorporates ESOP related income or stock option related income. So very important to find out the actual work days where this service was rendered. If there was a multi-country role kind of a thing where there was work that was discharged at different countries, then that adds in some more layers of complexity. And one fact is that in India, like we discussed right at the start, taxability is dependent on the place where the income is earned, which in this context will be where service is rendered, but also where the salary is paid out. So even taking a very simple example, if someone's payroll is in India and the salary gets paid in the Indian bank account, but that individual works elsewhere, then under the domestic law, the salary is taxable in India, and then you would have to take shelter under the double taxation avoidance agreement. So important point, factually needs analysis. The second head of income is rental income. Now, rental income, this again, it depends. Now, if you are a NR or a RNOR, then only rental income of a property based out of India would be taxable. However, if you are a resident and ordinary resident with worldwide income being taxable, you need to be mindful that your in case the house property is based outside India, that rental income also would be taxable in India. Yes, of course, relief would be available under the DTA and needs detailed evaluation. In terms of India, some aspects around the rental income. So if you have a self-occupied property where there is no rental income, then two such self-occupied properties or vacant properties, you can treat with zero value. So there is no tax that would kick in. A deduction in respect of the housing loan that you are paying towards this property would be available if you are under the old tax regime. Up to 2 lakh rupees is the maximum that you can claim. Under the new tax regime, it would not be possible to claim a deduction of this interest for a self-occupied property. Now, in case a property has been given on rent, then there are certain differential provisions that apply in case of a non-resident. So the simple one being that the rental income is taxable, whatever municipal taxes are payable on that property, those are deductible. There is a standard deduction that is available to determine the net rental income. Now, in case if the landlord or if the person who has given the house on rent is a non-resident, then the tenant needs to deduct taxes. If the rental value exceeds 50,000 rupees per month, needs to deduct the taxes at 30%. And many a times what happens is that for such a non-resident, the Indian income may not be much. So 30% might be an additional burden for him. And in such situations, it is possible to reach out to the Indian tax authorities through there's an online process that has been specified, and opt for lower tax withholding that the tenant can do on this income. Such taxes need to be deposited with the Indian government. There is some withholding tax return that need to be regularly filed, and a certificate needs to be issued to the non-resident landlord. Now, when you compare this to a resident landlord, in case of a resident landlord, the complexity is much lesser. There are simpler procedures that have been notified. But until now, for a non-resident landlord, there is no change. And yes, these provisions are complex that kick in. Now, in terms of capital gains, now this is a head under which in the last budget that was announced by the finance minister on 23rd of July, there were big bang changes that were brought in, and the changes were in a move to simplify the taxability, the classification into long term and short term of various assets. But we must say, at least until now, the simplification is not much. We are still grappling with identifying on various kinds of assets, what would be the tax treatment, when would they be short term, long term. But in order to discuss the overarching principle that the finance minister had laid out, was that in case of a listed security, the period for holding would be, the cutoff would be 12 months. So in case if you hold an equity share, a listed equity share, then in case if you hold the share for 10 months, then that would be a short-term asset. As against that, if you've held that for 13 months, that would be a long-term capital asset. And that's how the gain would be taxed, either as short-term or long-term capital gain, and the tax rates are as you can see on the screen. So until 23rd July 24, in case of a short-term capital gain from equity shares or units of equity-oriented mutual funds, were taxed at 15%. That has now been enhanced to 20%. And for any other short-term asset, maybe unlisted or immovable property, if we can put it at that, that would be taxable at the applicable tax rate to the individual. Now, under the double taxation avoidance agreement, we have typically seen that for shares, for sale of shares, there might be sometimes some beneficial rates that might be specified. But for other kinds of assets, there may not be a rate, and many a times the provision states that you need to adhere to the provisions of the domestic tax laws when determining taxability. However, for some treaties that we have seen, some DTAs that we have seen, there is some typical language which says that the gain on certain kinds of assets will be taxable only in the country in which the individual is a resident under the DTA. So how does this work out beneficially is that if you are referring to units of debt oriented mutual funds or equity oriented mutual funds, and Indian mutual funds, on sale of these units, if the individual is a resident of some overseas country with this specific clause being available, then he will be able to exempt those gains from tax in India. So very important to go through the language of the tax treaty and then evaluate if you can avail such kind of a benefit. In terms of the long-term capital gain, whenever you sell or alienate any long-term capital asset, then that would be treated as long-term capital gain. Typically, the rate for long-term capital gain other than equity shares and equity-oriented mutual funds was 20% with indexation. Now, after the budget that we spoke about, 23rd July, after that date, the rate has been brought down to 12.5%, but the indexation benefit has been taken away. For residents, such indexation was partially reintroduced in case of an immovable property purchased before this date, but that option is not available to non-residents. As for equity shares and equity-oriented mutual funds, I think a couple of years back, there was a differential tax mechanism that came in, wherein up to 1 lakh rupees was non-taxable and the tax rate without indexation for the balance gains was 10%. That has now been changed to 12.5%, but the exemption related limit has been enhanced to 1.25 lakhs. In terms of interest income, now typically people based outside India have Indian fixed deposit, savings account, NRE, NRO accounts. So NRE accounts and NRE deposits, there is some dispensation that is available which are exempted from Indian tax as long as you qualify as a FEMA non-resident in India. If you are a FEMA resident, then these also are taxable in India. In case of NRO, savings accounts, fixed deposits and all, they are taxable at the applicable slab rates under the Indian domestic tax laws. Under the DTAA, we've seen that there are beneficial rates that are specified which can be availed. So again, important for you all to go through those clauses. First, evaluate where are you a resident of, and then see if you can make use of these rates as well. Lastly, dividend income. Now, for dividend income, where in case of a resident, in case of an Indian resident and investment is made in Indian currency only, it is the applicable slab rate that is considered for the tax for the purpose of determination of taxes on dividend income. However, for a non-resident, the rate of tax on dividend income is 20%. And in case of units of mutual fund wherein the investment has been made in foreign currency, the units have been purchased through foreign currency, the rate of tax is 20%. Yes, there are beneficial rates available under the tax treaties as well. So very important for you to evaluate whether the provisions of the domestic laws or the DTA are more beneficial, and then you can disclose or consider such rates at the time of your tax filings. So I would just like to reiterate a couple of points on the benefits under the DTA. So one is that availing these benefits is extremely factual. For determining whether you are eligible for this benefit, one, determination of residential status under the Indian laws and under the overseas laws is required, and followed by determination of residency under the double taxation avoidance agreement. Only after this residency is determined can the interpretation of the remaining articles of the DTA be carried out to determine where and how should you be taxed. So with that, there are certain compliance aspects and common issues that we've seen NRIs face when making filings in India or complying with various provisions that kick in. So the first one is tax filing due date. Now 31st July typically for individuals is the tax filing due date. In case if you want to opt for the old tax regime, very important for you to make your tax filing before this date. Yes, there is a provision available for making belated filings or revising the tax filings. That can be done until 31st December, but then you cannot change your tax regime in the belated filing that is done. In case of any delays in filing beyond 31st July, there are some late filing fees that have been prescribed. So, and I mean, in case if there are any carry forward losses that you all need to consider on any refunds that you want to claim, then very important that you adhere to the timeline of 31st July. If your income is below 2,50,000 Indian rupees, then you can skip filing your tax return. But from a continuation perspective, in terms of filings, in terms of the tax return copies required for various purposes, it is always better to ensure that your filings continue in India. The next one is tax return form. So the income tax portal is now very user friendly, and wherein you can see the details of various tax return forms that are available and the heads of income depending on which you can figure out what is the correct tax form for you. While making the tax filing, very important for you to take into account the details that are visible in your Form 26AS, in your annual information system, total information system, because here details of your savings, interest, dividend, which typically we tend to forget or miss out, those details are also given. And in case if there's any mismatch with this, then there is at the time of evaluation of your tax return and the time of processing of the return, these aspects are immediately pointed out, and then you will have to pay taxes on the same with interest and penal consequences. Advance tax, a provision that is relevant if the taxes payable in India are in excess of 10,000 rupees. So there are 4 slabs in which you can discharge this advance tax liability. So by 15 June, 15 September, 15 December and 15th March, in order to avoid any interest implications, it is important that you are cognizant of this provision and do the calculation of how much tax is payable on an estimated basis. Deductions, there are various deductions available under the Indian laws under the old tax regime, to be precise. If so, for any premiums that you are paying towards life insurance, health insurance, repayment of housing loan, so there's a whole list that is available. But with the new tax regime being more popular, most of these deductions would not be available under the same. Indian asset and liability disclosure, very important to be mindful of this, and this is applicable irrespective of your residential status. If you have net income exceeding 50 lakh Indian rupees, then you need to mandatorily disclose details of your Indian assets and liabilities. The typical assets would be bank accounts, immovable properties, vehicles, all of those details. The cost of acquisition and whatever assets that you've held as on 31st of March need to be disclosed in your tax return. Additionally, for individuals qualifying as resident and ordinary resident, that is people who are taxable on worldwide income in India, and they need to also disclose their foreign assets and foreign income in India. Non-disclosure would attract stringent penalty under the black money law along with the income tax law. So very important to be mindful of this. Some aspects that get missed out is that people who are based out of India but have stock options of the overseas companies, those also would be foreign assets and need disclosure in the Indian tax return, along with the typical ones being shares, immovable properties, overseas bank account balances, and all. Then TCS on foreign remittance, Pramod touched upon this when he spoke about the budget provisions. So whenever anyone is making foreign remittance under the LRS scheme, that is liberalized remittance scheme, which is applicable only to residents, then there is a 20% TCS that kicks in. The limit was 7 lakhs until 31st of March 25, and in the budget has been enhanced to 10 lakh rupees. So very important in case for people based outside India, if their relatives who are Indian residents are remitting money, then this would be of relevance. Yes, credit is available in respect of this TCS, but then it creates a temporary cash flow issue. So very important to be mindful of these numbers. However, TCS is not applicable whenever there is a remittance being made for education purposes from a loan taken from specified institutions. So this is a change that has been brought about in this budget. And lastly, lower withholding certificate. So I did touch upon it when we spoke about the rental income related aspects. So whenever there is any tax to be deducted from the payment to be made to a non-resident, that is any TDS to be done from the non-resident, many a times higher tax rates kick in. And what is important is to evaluate if the total income of that non-resident is lower and thereby the total tax liability for the year would be lower, then there is a provision whereby the individual can voluntarily go to the income tax authorities, indicate details of the estimated total income for the year, previous year income details and all, and apply for a lower withholding or no withholding tax certificate. This certificate can then be produced to the person who is making the payment, and the TDS is done in accordance with that. So this helps in alleviating the cash flow issue which may arise, because if there is high TDS at a earlier stage and then you have to claim a refund later, that leads to some cash lock. So these were certain aspects that we thought would be relevant to you from an Indian tax perspective. And maybe with that, let's go on to the questions and answers.
Great. Thank you so much for this insightful presentation. I'm sure this initiative provides clarity on key takeaways from the budget, and we can reduce, how we can reduce our tax liabilities. So that was really, insightful. Thank you. Now we will move to our question and answer session, where we have received questions from about 1,000 NRIs who are attending this webinar across the globe. But due to time constraint, while we will not be able to cover all these questions, however, let me try and ask a few most common ones related to the topic. So I think the first question is for Pramod. And the question is, what are the implications of sale of property in India by an NRI?
I think that's an easy one. I guess Meera did cover it, but you will first go and see, is this property being held for how long? Is it long term or short term? If it is held for lower than 24 months, it will be regarded as a short term gain. And if it's held for more than 24 months, it will be regarded as a long term gain. Again, below 24 months, the tax rate, it will be taxed at the applicable slab rates, so no special rule for sale of property. But if it is held for more than 24 months, and it's a long-term asset, then, it will be taxed at, and the property sold after 23rd July 24. That's when that mega change happened. The tax rate will be 12.5% plus surcharge and cess. So that's the rate of tax as per domestic laws. you
Right.
you will have a higher rate of 20%, for property which is long term and sold prior to 23rd of July. Again, caveats there. You may have, certain exemptions by doing reinvestment, buying new property. So you'll need to do all of that, look at all of that before you file your return. Again, when you get, if you are selling a property as a NRI and, there is a resident who is purchasing the property, he is very likely to do a tax deduction at source. And, if you need a lower rate, or a proper rate of deduction, he may insist that you get a certificate from a tax withholding officer. So, that again is something that you need to keep in mind. And the last point, like Meera said, if you are eligible for some tax treaty benefit, you need to just evaluate that also. Typically for property, we have seen that it ends up being taxed, you don't get any treaty benefit, but you should just go and revalidate that once, as to what exactly is the treaty language. But that's how property taxation works.
Okay, great. Thanks for this reply. So the next question again, Pramod, is for you. What are the capital gain tax implications for NRIs on sale of mutual funds, shares, and ETFs?
Right. So maybe, first again, I will divide this into listed and unlisted space. Insofar as listed is concerned, 12 months is typically the threshold, which is seen to decide whether some asset is short term or long term. Now, for listed assets, which are short term in nature, less than 12 months you have held, the tax rate which is applicable is 20% plus surcharge and cess. Whereas insofar as long term assets are concerned, any of these shares, mutual funds, ETFs, which are listed, the long term rate is 12.5% plus surcharge and cess. So, that's how the listed space will work. Now, unlisted is where things start getting very tricky, and there are different provisions which are there. But the most common one, mutual funds which are covered under, there's a particular section called Section 50AA, which defines specified mutual funds. And that definition says, these are all mutual funds. Today, the definition says it is where the investment in equity units is less than 35%. From 1st April 26, there's an amendment to that specified mutual fund again to say that it means any mutual fund where the investment in related debt and money market instruments is, more than 60%. So that 65%, sorry. So that you have to first see if you fit within that specified mutual funds. For the unlisted mutual funds, if you fit in there, then, the way it reads is that for short term, which is the slab rates apply. And for long term, there is a deeming fiction which say that everything will be deemed to be short term capital gains. That's a change which has been brought in. Now, there again, there are some nuanced positions which suggest that you can still apply a long term rate, which is 12.5% to some of these deemed short term capital gains. That is very litigative. So you should do that with advice. The simple answer, which seems to be coming out from plain reading of the bare law is that, for these mutual funds, the long-term scenarios, they'll be deemed to be short-term capital gains. Finally, for ETFs, which are not listed, again, for short-term, which is less than 12 months, it will be taxed at the slab rates. For long-term, it will be taxed at 12.5% plus surcharge and cess. So that's the broad answer, and every time when, because of this, some mutual funds before 1st April 23, which are acquired, they have a different rule. Once, after April 23, a new rule. 1st April 26, again, a very different rule. So because of this whole khichdi, so to say, of rules which are there, the direction is to simplify. And, that's what the FM did last year when she, in July introduced a lot of changes. But I would always suggest, go and check it out in detail, take advice, before implementing it. Always good to do it that way.
Perfect. Thank you. This next question, this is for Meera. And the question is, what are the tax implications for holding shares in Indian companies for the OCI, overseas citizens of India?
Right. So in terms of implications of holding shares, there are none. So just merely by holding shares of an Indian company for an OCI, there will not be any tax trigger that would happen. The tax trigger would be at two events. So one is whenever there is a sale of the shares that happens, and then depending on listed, unlisted, we've spoken about it at length, the tax treatment would kick in. Also, there would be tax that would apply in case if there are any dividends that are received on these shares. So to summarize the answer, just for holding, there's no tax treatment that kicks in, and it is only when the shares are sold or there is any dividend received on that you will have to look for the tax treatment.
Okay, sure. So the next question is now for Pramod. And the question is, how does the budget impact the NRI status in terms of tax residency day count criteria, as well as the reporting requirements for foreign assets and bank accounts held by NRIs?
Yeah, so there's absolutely no change insofar as these aspects are concerned. The tax residency, Meera covered it in detail. It's based on number of days mainly. So, that absolutely no change. Again, foreign reporting of assets, Indian asset reporting, all of those conditions, remain as it is. This particular budget, there's absolutely no change in any of those reportings.
Right. Okay, great. The next question, this is for Meera. If we receive a gratuity final settlement in Oman in April 2025, a little longer one, and remit the funds to India and subsequently return to India and become a resident for the financial year April 2025 to March 2026, will the gratuity amount be taxable in India? Alternatively, can we claim any benefits under the double taxation avoidance agreement?
I think yes, a good one, I would say. So, gratuity, now the way it would go is that if the gratuity pertains to overseas employment, then unless the individual qualifies as a resident and ordinary resident in India, it may not be taxable in India. But given that that individual is relocating to India and would be in all likelihood in India for more than 182 days, he may very well be an ROR. So that gratuity income may also be taxable here. Now, in case if the income is taxable in India, we can look at availing the benefit. There is some exemption that is prescribed under the income tax law for gratuity. So depending on how it meets that criteria and all, we can evaluate if that exemption can be sought. If not, if the exemption is not available, that income would be taxable in India at the applicable slab rates to the individual, the tax rates, the increasing tax rates that we spoke about. However, in case he is a resident of Oman and there is a concept of split residency under the double taxation avoidance agreement, there are some judicial precedents in India also available on this point. In case if we can split his residency in a manner in which until his return to India, he is a resident of Oman, and during that period he is taxable in India only on Indian income. By that manner, that gratuity can be exempted from tax in India, but needs greater evaluation in light of for what period has he got that gratuity, how is that calculation done, residency in Oman vis-a-vis residency in India.
Correct. Okay. Got it. I guess that should help him, plan this. So, Meera, the next question again is for you. While you have already covered this in some part of your slides, but again, what are the residency rules for ROR, RNOR, and NR, if that you can reiterate? And also, how does tax department understand or analyze number of days we are resident in India? While you already covered, but I think it'd be good if you can just reiterate.
Sure. So an individual is classified as a resident or a non-resident depending on the number of days. So at a very high level, someone who has stayed in India for more than 182 days in the present financial year, or if he has lived in India for more than 60 days in the present year and more than 365 days in the previous 4 years, he would be a resident. There needs to be further drill down to determine whether he'll be a not ordinary resident versus an ordinary resident. Very simply, a person who has stayed in India for more than 730 days in the previous 7 years and has been a resident in 2 out of 10 previous years would be an ordinary resident, vis-a-vis person who has met either of these or not met both of these conditions would be a not ordinary resident. There are some further conditions that have been prescribed for a person who goes outside India for the purpose of employment or who is visiting India depending on his Indian income. Also, there is a concept of deemed residency that is applicable for citizens of India who are not taxed in any other jurisdiction. So that would be maybe a bird's eye of how the residency is determined. Conditions are complex, need to be evaluated having regard to the physical day stay in India. And these day stay are determined based on passport stamps. So the way the income tax authorities also evaluate this is that if there is any treaty benefit that you've claimed or any exemption that you've claimed in your tax return and you've disclosed your residency in maybe as a non-resident, then if your case is selected for tax assessment, the authorities will call for proof of your passports. They will ask for your passport copies. They'll get you to plot a calendar from which they will determine whether you were actually that residential status and then whether the tax implications have been correctly mapped.
Right. So basically it's your chartered accountant or your tax consultant who would be the right person to, guide you with your residency status, isn't it?
Correct.
Perfect. Now, I think since we have, we are short of time, we'll take this last question for Pramod and then we can wind up. So Pramod, the last question is for you. Is the option to apply indexation available for NRIs when calculating long-term capital gains from the sale of real estate after 23rd July 2024?
Yeah, I'll come to that. Just word of caution on the earlier question. It is good to keep passport copies, as proof. Whenever any audit happens, they look at passports as evidence. And sometimes in some countries, for getting a new passport, you need to submit your earlier passport, and if you don't get it back, then ensure that you have kept photocopies of that full passport, because that's the key document that authorities typically look at for looking at the number of days stay. They look at these passport stamps of dates of arrival and date of departure. Though even that is evolving, with the way countries are now, sometimes not even stamping, it is all evolving, and you may need other proofs like travel ticket and hotel stay vouchers, and all of those documentation may be needed. Going to your question, there is no concept of indexation anymore for any real estate which is sold on or after 23rd of July 24. That's the date where this concept of indexation has completely been removed. There is one small element of indexation for real estate which still remains, which is that if you have some real estate which you have purchased prior to April 2001, then, the way the provisions read is that, you can go and get a valuation done. You can go and get a fair market value as on 1st April 2001, as the cost. You have an option to take the real cost prior to that date, or you substitute it with the fair market valuation as on 1st April 2001. So to that extent, for very old properties, you may get a kind of an indexation up to April 2001 indirectly through this substitution of fair market value. But as such, concept of indexation is no longer there. That's completely eliminated.
Okay, great. So great. Thank you so much. With this, we come to the end of today's session. We hope you found this session useful. We also have a feedback form for today's session, which will appear on your window. I will, quickly request all of you to take a minute and fill the form to help us make our sessions more insightful and relevant for you. As I mentioned earlier, we will be bringing more high impact sessions on multiple topics in subsequent months. Thank you very much for being with us today, and we look forward to seeing you again in the next webinar. Until then, please take care, stay safe, and bank on us. Thank you.
Thank you.
Thank you, Meera. Thank you.